السلام عليكم ورحمة الله. السلام عليكم ورحمة الله. In the name of Allah, the most gracious, the most merciful, praise be to Allah, and peace be upon His Prophet Muhammad, his family, friends, until the day of judgment. Inshallah, our study today is chapter 2. Chapter 2 is corporations, dividends, retained earnings, and income reporting. And we'll start with the first part in this chapter, which is dividends. Dividends is a corporation distribution of cash or stock by a corporation to its stockholders on a pro rata basis. Again, a dividend is a distribution of cash or stock by a corporation to its stockholders on a pro rata basis. It means proportional basis. It means according to its one ownership. Actually, dividends may be take four forms: cash, property, and scrip. Scrip means promissory note to pay cash or stock. This is the types of dividends, but we will concentrate on only two of them because this is the most important. Two of them is cash dividends and stock dividends. Today is a cash dividends. Dividends, it might be distributed quarterly or annually or semi-annually as a dollar amount per share. Again, dividends may be distributed quarterly, annually, or semi-annually as a dollar amount per share. Then, most of the time, it is semi-annually because many people depends on these dividends in their living or in their income. So most of the time, or usually, it is semi-annually. Cash dividends to be paid by the corporation must have the following condition. Cash dividends to be paid by the corporation must have the following conditions. Number one, retained earnings. It means we have enough balance of retained earnings, enough to distribute cash. Number two, adequate cash. It means we have balance of cash enough to distribute cash and declare the dividends. These dividends must be declared before we make any distribution. So again, we have three conditions to distribute cash: retained earnings, adequate cash, and declared dividends. In the cash dividends, we have 3 dates. We must know them. We must study them. We must practice them. The first one is declaration date. The second one is record date. The third and the last is the payment date. First, the declaration date. Declaration date means is the date when the board of directors formally declared the cash dividends and announces it to stockholders. Again, cash date is the date when the board of directors formally declares the cash dividends and announces it to stockholders. The declaration commits the corporation to a binding legal obligation to, again, declaration, it is an obligation. It means the declaration commits the corporation to a binding legal obligation that cannot be rescinded. This declaration cannot be rescinded, whatever the reason is. Again, the declaration date, when it is announced, this declaration cannot be rescinded, whatever the reason is. This is the declaration date. And this dates usually after the annual meeting of the annually general meeting, and it is announced by the board of directors. The second date, which is very important, is the record date. Record date is the date that marks the time when ownership of the outstanding share is determined from the stockholders' records maintained by the corporation. Again, record date is the date that show the time of the date when ownership of the outstanding share is determined from the stockholders' records. These stockholder records, as you know, it is maintained by the corporation. The corporation maintains these records, and in these records we mark the date. The date to which the stockholders is must have this payment, is the one who must have the payment. If he owns the shares in this date, in the record date, then he is the one, because as you know, these stocks or shares, it is transfer from one shareholder to another in the stock market. So we have to mark a date to determine a date. In this date, if the stockholders own this one, then he is entitled to this distribution, to this cash. The purpose of this date is to identify the persons or entities that will receive the dividends. Again, the purpose of the record date is to identify the persons or entities that will receive the dividends. As you know, the stocks of the shares are owned by either entities or individuals, so or persons. So the purpose of this date again is to identify the persons or entities that will receive the dividends. And the last date we should know from the three types of date is payment date. Is the date which dividends are mailed or are put in the accounts for the stockholders. It is put in the or mailed to the stockholders' accounts. Then we can ask, what are the journal entries or the accounting entries should be made for these three dates? We don't need to record anything about the record date, but we should make journal entry at both declaration date and the payment date. Then the accounting entries are in the declaration date. And it should be as follow: cash dividends debit, and the credit is dividends payable. And it does mean that these cash dividends must be obligations, must be a liability on the corporation. It is like any liability. Then if the company hasn't paid it in the time it's determined, then the stockholders can take the company to the court. So we make the declaration journal entry at the declaration date: cash dividends debit and dividends payable credit. And I said before, there is no entry is made on the recorded date, and I repeat it again. There is no entry is made on the recorded date. Then in the payment date, when we should pay the dividends, then the debit would be dividends payable, to pay the obligation, or the debt to the stockholders by making the journal entry dividends payable debit and cash is credit. Again, in the payment date, debit dividends payable, credit cash. And this is like any payment. Cash, you determine cash is credit, because always when we pay any amount from the company, cash is credit, as you know. So the debit side, dividends payable. The credit side is cash, and the amount is the amount determined. The allocation of the cash dividends. Should be as follow. We have the total dividends and then we deduct from it the allocated to preferred stock, the amount allocated to preferred stock. Either it is a percentage of the par value, or it is an amount. We allocated it to the preferred stock. Then, if there is dividends in arrears, it should be first. If these dividends for 1 year or more should be paid first, and or should be allocated first. Then the current year dividends should be also allocated to preferred stock. Okay. Then total dividends less or minus the part allocated to preferred stock, which include two items: dividends in arrears, either for 1 year or 2 years or whatever, if this one is cumulative, if this preferred stock is cumulated. But if it is not, there is no allocated to preferred stock at all. But it should be cumulative. Then after we allocate the preferred stock, the dividends in arrear for any period, then we add to it the current year dividends, and both together, the dividends in arrear plus current year dividends, we add both together and deduct them from the total dividends. It gives me remainder allocated to common stock. Again, it gives me remainder allocated to common stock. Okay, this is the cash dividends when we make allocation to the cash dividends. Then there is a journal entry should be recorded at the end of the year, which we call it adjusting entry. Then at the end of the year, the journal entry would be retained earnings debit and cash dividends credit. Okay. Then again, we have cash dividends at the declaration date. Then we close it at the end of the year in the retained earnings. So cash dividends is debit, to be closed should be credit. So at the end of the year, the closing entry is be retained earnings, cash dividends. This is the journal entry at the end of the year: retained earnings, cash dividends. Then we should know the dividends preferences. Preferred stockholders have the right to receive dividend before common stockholders. This we call dividend preferences. Dividend preferences, it means preferred stockholders have the right to receive dividends before common stockholders. They should receive their amount or this percent first, then the common stockholders can share the rest of the remaining. And if the preferred stock is cumulative, then preferred dividends not declared in a given period are called dividends in arrear. The dividends in arrear, I mentioned it before, but now I explain to you where we can have dividends in arrears. If the preferred stock is cumulative, then it should be cumulative dividend. Preferred dividends not declared in a given period are called dividends in arrear. Again, preferred dividends not declared in a given period are called dividends in arrear. Dividends in arrear, it means this is cumulative dividends. Corporation cannot pay dividends to common stockholders until it pays the entire preferred dividends. The entire preferred dividends. So you should pay to the preferred stockholders first, then they can pay the other to the common stockholders. Again, we pay to the preferred stock if it is cumulative. The entire preferred dividends. The entire preferred dividends means dividends in arrear plus current year dividends plus current year dividends. Then I think it is now easy to understand what is meant by cash dividends. Then any question, please. If you have any difficulty, okay, then all the best, and I'll see you next time, inshallah. Assalamu alaikum wa rahmatullahi wa barakatuh.